Which market is the best for the midterm rental insurance strategy? I have a very simple answer for this question, but you're going to have to watch because there's two caveats to that depending on where you currently at in your journey, whether you're currently in a short-term rental market or you're currently looking to purchase or co-host or manage using this strategy. I have two critical pillars that I want to make sure that you are aware of before you pull any trigger or before you fully dive in, because this is one of the most commonly asked questions, and the response that I give is, I guess, unpredictable, or when that would where people's minds do not go first because they're thinking market, 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 market. The truth is, there isn't a specific market that we can point the data towards that will show us that this is where all the insurance claims are happening. Now, if this is your first time tuning into this video, the midterm rental insurance strategy is based on events that occur to homeowners, unforeseen events where they are then temporarily relocated due to these events. Now, these events are not just limited to like a tornado or a flood that happened in a specific zip code. They're very individual scenarios that are actually very prevalent in this marketplace when you are aware that they exist. We're talking about pipes bursting, we're talking about trees falling on homes, we're talking about a home being uninhabitable for the next month or so with unforeseen forecasts of how long it's going to take to fix it. Therefore, they need to be temporarily relocated, and our avatar is typically large families, which is actually one of the hints as to how to actually reverse engineer and position yourself as the type of asset that you should be focusing on before you think about the market. But you should be thinking about the market, and it is very important for you to think about the market, and I want to cover this in a second, right? So when we think about where is this most prevalent? Where do all these insurance claims happen? How do they happen? Well, first of all, the way it happens is when an unforeseen event happens, typically the policyholder, which is the individual who's paying a premium every single month, right, or they pay it on a yearly basis as part of their mortgage. When an unforeseen event happens, we go and tap into the loss of use on their insurance policy, which then opens the eligibility for the individual or the family to relocate based on and it is driven by the value of the home and how much loss of use they have under their policy. And usually there's a bulk amount of money, and that is why we're able to charge a premium when temporarily relocating this family. Now, the reason the alternative isn't as sexy, for lack of better words, to relocate into a hotel is because when they're coming from a larger home, hint, it's more of a nuisance to be in a hotel of 2-bedroom suite or whatever the case might be. They don't have the living room, they don't have a dining room, they don't have the kitchen, so it's not what they're doing. If you're currently getting value from watching this video, you'll want to make sure you take a second and click below to grab the midterm rental insurance blueprint to help accelerate your process in being able to land these midterm rental insurance contracts with respect to your marketplace. Make sure you click the button below and grab it and continue on with the gems in this video. They're literally coming from a home and going to a hotel, and it's not very ideal. Hint, hint. So when we think about a strong marketplace, before you get into the space, before you understand that it is very driven by the assets, it's really important for you to think of what is going to be my exit strategy. And for this reason, in simple terms, what is the best market for you to start the MTR insurance strategy? It's one that has a strong short-term rental market. I'm going to say that again. The reason why you want to start with a market that has a strong short-term rental market is because there isn't a way for us to have enough data to show how prevalent these are happening, even though I will say if you're properly optimized, which is a whole nother conversation, to receive these in your right databases, you're reaching out to relocation specialists, you have a relationship with them, they have a relationship with you, which you can actually build very quickly. On a note on that later, until you have that, it's not something that you can predict, right? And because of that reason, you're going to want to make sure you are in a market that has strong short-term rental numbers, because the last thing I want you to do is say, hey, I'm going to do this MTR thing and that's my only game plan, and then you don't have any inquiries and you don't have the relationships built yet and you're sitting empty and there's nothing nothing for you to do there because you do not have a strong exit strategy. My exit strategy, our exit strategy, and the exit strategy of anyone that I'm teaching this to has to have a strong short-term rental market. Now, it does not mean that you're going to say, hey, I want to start Airbnb, but it does mean that if you're not going to MTR insurance bookings, or because there's, again, due to lack of demand, if it comes in waves, sometimes you get tons of inquiries and then sometimes it might slow down a bit. You want to make sure that you can still run the short-term rental play. Okay, I'm going to put this on do not disturb. You want to make sure that you're still in a market that allows you to capture stays for the time being until you have a midterm rental contract, which again are very lucrative and can last a long time and get you 100% occupied for a long period of time, anywhere from 3 months, anywhere for 2 months, anywhere from 6 months, anywhere to even 12-month contracts that are lucrative, paid by the insurance companies. Now, to answer your question, the best market is to be in the market that has a strong STR market, so that when you don't have a contract, you can run the short-term rental play, aka strategy, until you land a midterm rental contract. This is so important. If you are currently in an HOA, if you're currently in an area that restricts short-term rentals, that is not your best MTR insurance strategy. Do not use the MTR insurance strategy as a band-aid because you're unable to do short-term rentals. I would say that is a recipe for disaster, because now you're literally not even giving yourself a chance of having bookings when you don't have MTR. And if you're anything like me, I believe that an asset should always be working for you, and you should not be working for your asset. You're going to be working for your asset if you're in a position where you're not allowed to run short-term rentals and you're not to have Airbnb restrictions. Now, there is a caveat to that. For those who are currently, that is your situation, and you do have like a 30-day restriction, your HOA won't let you, etc., you can still do the strategy, no harm done, and still be able to solve this problem or solve this gap or lack of, currently if you have some vacancies because of this 30-day minimum. However, I would not rely on as a long-term strategy. Yes, you could get a 6-month contract. Yes, you can get a 12-month contract, but you're going to be facing the exact same situation again in the next 12 months. So if you're in a position where you're thinking of even remotely of entertaining this idea of being HOA that doesn't allow you to have STRs, first of all, I would run in the other direction, because I stay away from HOAs like the plague. But second of all, I would just really be clear on, if you're gonna get into an HOA, what is the governance there, and what is the body, the makeup of that audience? How do they feel about STRs? Do they want to ban them? Are they already currently banned? Do you have someone who's rooting for them, which is hard to even say that out loud? Is someone rooting for short-term rentals? But I think what we're asking is that something that's part of the market's culture, right? If you're in a market that is STR friendly, location friendly as well, they're literally, their economy is based on having multiple vacation rentals, and they literally welcome that in open arms. That's a good market for you, right? Now, the second thing, right, in addition to having a strong market, strong short-term rental or vacation rental market, that's the number one, right? Number two is you want to have the right asset type, right? The reason this is very important is because I often get questions around this, and not all midterm rentals are created equal. Let me say that one more time. Not all midterm rentals are created equal. The reason that is because the asset type will dictate the type of charge that you can charge for the product that you have, right? If you're talking about 1 bedrooms, 2 bedrooms, now really you fall in the bucket of Furnished Finder. Furnished Finder was first established as, a traveling nurse website. Traveling nurses typically have a budget, and it was meant to cater to them, right? So maybe they're looking for 1 bedrooms, kitchenettes, affordable. Maybe they're splitting it with another nurse, travel nurse, and they're known to be on the budget, right? And if I'm trying to base my business model, I'm not trying to base my business model based on an avatar that has a budget, right? Or if they do have a budget, I want it to be a large budget, the way we see it in the insurance industry, where the adjuster is still basing it on that loss of use, that coverage D, which is derived from the coverage A, which is typically 20 to 30% of the dwelling value of that property. That is how they derive the coverage D, which is a great lump sum when you're looking at a $400,000 property, $500,000 property, $300,000 property, right? Call it even 250. There's still a good amount of substance there that you can pull from. Call it $1 million property. Again, little caveat to that, to know that in certain areas, you're gonna make sure your dwelling value is truly what they're deriving that coverage D from, because some properties are in expensive states, and really you might think that the property is worth $1.6 million, but really is the $1 million is land, and the land has nothing to do with the dwelling value. Dwelling value might be 500,000. So keep that in mind. But otherwise, they're deriving it from that avatar has a large budget, because the chunk size is derived from the value of the property, and that's how they're able to approve and deny the proposals as you make them when they inquire about you hosting them in a furnished accommodation with Wi-Fi, pet friendly, etc. You make a case for yourself, and they're paying a premium. It's harder to make a case, or at least I should say, if you put two case side by side, a 2-bedroom case versus a 5-bedroom case, because the 5-bedroom is solving a larger problem, a larger space, you're going to charge more of a premium for that versus than a 2. Does not mean that a 2-bedroom does not work. It does not mean that we haven't gotten contracts for 2 bedrooms. We actually only, the lowest we've gone is 3 bedrooms, right? Based on what we have in our portfolio. But it's really important for you to understand that not all midterm rentals are created equal. So when I'm thinking of like, what is the best strategy? What is the best market? First, market is going to be the strongest short-term rental market, is going to be your strongest midterm rental market, because it'll give you an exit strategy. And then as soon as you answer that question, you want to make sure you say, what is the type of asset that we have? We have a 4 to 5 bedroom is their sweet spot, because it's a larger home, fenced in backyard, master on main, walk-in shower, no stairs in the front, accessible anywhere without stairs if possible. Doesn't mean you can't have a second or first floor, third floor, or a basement. It just means can I access the home without accessing the upstairs or downstairs, because you have to keep in mind that there is the silver tsunami that is around the corner, which means that we're going to have more old folks than young folks in the next coming years. So want to keep that in mind. Does it have a garage, etc.? Does it have carpet? I don't want carpet. I want it to be pet friendly. Those are all things that you need to think about your asset, and there's an entire video that describes this, which I will quote in the end. But you want to make sure that that is how you're positioning yourself. If you're looking to actually buy a rental to do this midterm rental insurance strategy, you're going to want to make sure that you're in a strong short-term rental market, and then the icing on the cake. Now, here's a couple insights as to how I look at a strong short-term rental market. There's a lot of information out there. Definitely want to make sure you cross-reference all this data, right? But here's some quick napkin math, because I can make an entire video on this. Here's some quick napkin math that should resonate with you. If you're going to look at a strong short-term rental market, I like to look at what's the ref part, what is the revenue per night, what is it making. A good rule of thumb is how much is the property worth, and is it bringing in 15% of the value of that property? So if the property is worth $100,000, is it bringing in $15,000? If a property is worth $1 million, is it bringing in $150,000 per year? That's a good napkin math rule of thumb, where it might get my interest. I'm like, okay, this is a deal. Another thing we want to look at is the zip code or the market, that occupancy for that property, 50% or more. Where can you look at this? You can look on airdna.co, Mashvisor, Rabu. Cross-reference all of them. Don't just settle for one. I want to have as much information as possible, because it's calculated risk at the end of the day. It's a calculation of the data. Men lie, women lie, numbers don't lie. But then it helps you have that at least foundation of what the numbers show in that marketplace. That is the fundamentals of short-term rental analysis. There's a lot that you can look at, like what do they charge per night, and then based on the occupancy, that's what was called a RevPAR. It's very important for you to understand those numbers so you can actually run that play. But it's also important for you to focus on the asset type, not so much the market, because the asset type will dictate very different numbers. And this is why we focus on the 4 bedrooms versus a 2. If you go on the short-term rental market and you look at what you can gross versus a 2-bedroom versus a 5, there's going to be a very big discrepancy, as it should be, because there's more beds and more people can stay there, and therefore you can charge more, right? Keep in mind, if you also have that fenced-in backyard, if it's pet friendly, you can charge more for the pets as well. So these are the fundamentals of short-term rentals. Does not change at all. Most people make that mistake mistake, but now that you've watched this, you will not make the mistake. And when someone asks you which market is best for the MTR insurance strategy, you'll say one that has a strong short-term rental market, and two, one that has the right asset type in that strong short-term rental market. If you got value from this video, make sure you watch my video called the midterm rental insurance buy box criteria.